Did you know that taxes are on sale? That's right, you heard me say that. Taxes are on sale. You say, well, Mark, what do you mean by that? Taxes are on sale. Well, let me first introduce to you Lamar Kerr here. He is a certified financial planner and a CPA. He works with our firm. If you have never been here before, I'm Mark Pruitt, founder of Strategic Estate Planning Services, and we want to try to answer that question of what do we mean by when we say taxes are on sale? So Lamar, why don't you explain that briefly to them of what that means now and then compared to what it's going to be January 1, 2026.
Yeah, the Tax Cuts and Jobs Act of 2017 lowered tax brackets, but the issue is that's going to expire, the way things stand today, that's going to expire January 1st of 2026. So you're correct, Mark, taxes are on sale now. We've got an opportunity for planning, and there are different things that different people may be able to do to take advantage of the fact that these taxes, are on sale now. It does present planning opportunities for us.
And so here's the question, why are they on sale and why are they going away? What's causing that? What caused it, number one, to go on sale? And then number two, what's going to cause it to go away?
Well, when the politicians wanted to lower the taxes back in 2017, there wasn't a way to really do that and make it permanent, just due to the budgetary issues and the number of votes that are required to get certain things passed.
Which they require 60 votes in order to get something permanent. And in Washington, D.C. today, in this environment, you can't get 60 votes for about anything up there. And so because of that, executive order kicks in. And when executive order kicks in, it can have a sunset or will have a sunset provision, which is what makes it go away.
So that's why, as of today, these rates from that 2017 act are in play, but it will end at the end of 2025. So starting January 1st of 2026, the tax laws will revert back to what they were before. So the biggest way that's going to impact most people it's really two things. It's the marginal tax brackets will go back up again.
Which means higher tax rates.
Higher taxes at every level of where those marginal brackets fall. And also another big item is the standard deduction will go down. So right now, that standard deduction for this year for a married couple filing jointly is $27,700. So that means you get to reduce your income by that amount before you come to what's called taxable income. And as a point of reference, back in 2016, that standard deduction was $12,600.
So it went from $12,600 to really $27,000, over $27,000.
Right. So that allows, in this case, a married couple to significantly reduce their income prior to taxes being applied.
Right. And
then you put on top of that the fact that the brackets are lower now. It's not 39.6% at the top of the charts, it's 37.
Right.
And on down to all the lower levels.
So what makes a good time then right now as far as opportunity? They've got all of 23, they got all of 24, and they got all of 25. What are you seeing right now that a lot of people are doing while these rates are lower?
Well, I'd say the number one thing we see and that we talk to clients about it would be Roth conversions. But in essence, you take money that's in a traditional IRA, and what that means is when you take money out of that IRA, whether you're using it for income and retirement would be one big example, you pay taxes on it. So the idea is while taxes are on sale now, I will convert some or all of my IRA into a Roth, go ahead and pay the tax now in full.
Right.
And then when it's in the Roth, that money will grow and never be taxed again.
I think it's interesting. It's a misnomer. People think they have an IRA and they've got $1 million in it as an example, and they go, hey, I've got $1 million. Well, you really don't. And the reason you really don't is you haven't paid tax on that money yet. So the question is the same. You're going to pay tax on the money. There's no way you're going to get around that. The question becomes, would you rather pay more tax on it or less tax on it when you have to take money out? And so the obvious answer, Lamar, is, well, nobody wants to pay more. We want to pay less dollars on that. Well, not only can you pay less dollars on it, you can convert pieces or portions of it to where all the growth in the future is tax-free. And then you don't have the strings of a required minimum distribution off of that while you're living, all types of positive things. You know, you're paying taxes on the seed versus the harvest. As that thing continues to grow, you've already paid the taxes on that.
That's right. And even for people that think they may not touch their IRA, they may think about the legacy they're going to leave their beneficiaries, leave their kids, for example. That right now, you know, kids, if they inherit an IRA, they have to distribute that money and pay tax on it over a 10-year period.
Right.
And they may be in their high earning years where taxes are high. So some folks will say, let me go ahead and do a Roth conversion, pay some tax now while taxes are on sale, get that into a tax bucket that is tax-free when somebody inherits that down the road.
And there's different ways to pay the tax, whether you pull the money out of the actual investment, whether you pay it with other dollars, whether you pay it with cash, whether you pay it with a required minimum distribution that you received in and you didn't need it that year. Take some of that money you could pay towards down on some Roth money, the taxes for that. There's all kinds of different ways to do it, and we just want to look at it and make it efficient. That's why you need to talk to somebody to make sure that what you're doing is as efficient, tax efficient as possible. And sometimes, you know, making sure we don't jump tax brackets or affect across a line that creates IRMA tax, which is a tax, another additional tax in regards to Medicare premiums. If you have too much earned income, it can change. And there's different brackets on that one as well. So there's all kinds of different things that can cause that. But you know, there's one more, Lamar, I think that's interesting, that not only for just converting money, but also right now doing a Roth 401k at work. You actually call a Fidelity or you call a Charles Schwab or wherever your 401k is, and you can actually, your custodian, so you got to call, not HR, you can call your custodian. And you can check a box right now that says, I don't want to contribute to a traditional 401k, I want to contribute to a Roth 401k. Well, and here's the same thing. You're paying taxes at a lower rate. Right now, you're paying taxes on a Roth 401k at a lower rate. Why? Because taxes are on sale. And so that's very, very important, but that's going away soon. Doesn't mean you would stop doing it in the future, but I would tell you these 3 years coming, 2023, 24, and 25, we know what the brackets are. And so we can reevaluate after that. But right now, we got a green light to be able to go and do that.
That's right. It's a good opportunity for planning. There are different ways we help our clients and help clients evaluate the implications of what we may be doing, and so it's a good opportunity. And right now, I think it's something that people need to at least consider trying to take advantage of.
Yeah, at least explore it just to see if it would fit them. And I think in the end, they would know whether it would fit or not, and we would too. Any good advisor would as well. So. Well, listen, if you've got questions on that, feel free to call us at 1-800-381-8870. That's our office. Lamar or myself would be more than happy to talk with you and explore this option to see if it's a fit for you. And also subscribe. There's a lot of videos like this that we have that are not too long, but they're long enough to be able to give you some good, valuable information. And we hope that you did find this helpful to you. Because the one thing I can tell you, when it comes to your money, it pays to be strategic.